our next guest does think the Greek bailout will lead to higher volatility and lower value for both the euro and the pound, with both currencies underperforming gold in the medium term. He is head of inflation trading at Capstone Investment Advisors. Capstone is the single largest inflation trading desk in the U.S. Jacob Bourne, thanks for joining us. So specifically, your job involves largely trading tips, Treasury inflation protected securities. So I want to ask you about the performance there, but I want to begin with the price of gold because it's hitting another record for a second day in a row now. And people have said, guests, commentators have said, if you're concerned about debt and deficits, you play gold like a currency. But what I want to ask you, since you're an inflation expert, does it at all signal concern that inflation might be back to rearing its ugly head?
Yeah, I think the gold market is in some sense the canary in the coal mine here. A lot of markets seem to be that they're fighting the last battle, and corporate debt crises historically have been deflationary, while sovereign debt crises have historically been inflationary. So all of the playbook from the last crisis, which wasn't that long ago, doesn't look like it's going to apply this time, and the gold market is the first place that's signaling that.
So how long are we going to see this trend in gold prices where people just pile into gold?
Well, I don't know exactly how long the trend is going to be, but as long as people are worried that governments are going to print their way out of this mess, which it appears that they are going to do, I think that there'll continue to be upward pressure on gold prices.
Do you have a top, $1,300 announced anytime soon?
I think that, there's going to be a tremendous amount of volatility, and it's not so much what the price target is what it represents. And it represents that currencies are depreciating against real assets. And gold is the sort of most visible of those real assets and the easiest to trade, so that's where it's being noticed first. But I think that the message is clear, and that is that currencies around the world are going to be getting less valuable as time goes on.
That's interesting. So then what are the trends you're seeing in the tips market to reflect this?
Sure. I mean, tips have had a good couple of days, and this morning they are outperforming again. They are still, in my opinion, priced in too benign of an inflation scenario going forward. But in general, I think the markets are starting to become aware, and I think the ECB bailout that happened this past weekend is showing them that governments are prepared to print money to get their way out of this.
So then would you expect to see investors continuing also to come into U.S. Treasuries? We had a real strong result for the 10-year auction just a few minutes ago. And also U.S. stocks in rally mode again. I mean, the volatility is amazing.
Sure. I think the bonds, at some point, the U.S. bonds are clearly benefiting from sort of a flight to quality. And I think at some point, the United States government, our budget deficits are not in that much different than these European countries or than the UK. So I think at some point, regular treasuries are likely to suffer in the front of all of this once some of the volatility removes itself from the market. Equities are an interesting case because equities, of course, are real claims on real businesses. So one might think that they offer some inflation protection, but historically this has not been the case. The evidence is sort of incontrovertible that equities do bad in periods of high inflation. So while they might go up in nominal terms, they're unlikely to keep pace with the increase in the price level.
Do you anticipate continued volatility in U.S. equities?
I think that volatility is almost a certainty. When you have, our capitalist system relies on price signals to allocate resources efficiently. And as soon as you have inflation distorting those price signals, you have a less efficient economy. And less efficient economies sort of screams equity volatility, as you're unsure whether these earnings are real or just the effect of having too much money out there.
Okay, so now we've got Euro TARP, right? Or Le TARP, as some people have made a joke about.
Right.
We have emergency measures still in place here in the U.S. So what's the time frame going to look like to start absorbing some of these measures?
Well, I think that this is the really unclear point right now. I mean, there certainly is some excess capacity out there around the world. And so, whether the price pressures are a 2010 story, a 2011 story, or 2012 story, it's clear that they're coming down the line. Now, I personally think that the slack is not as great as other people do. This wasn't a traditional inventory recession. This was a real restructuring of the global economy. So there might not be as much slack as people are taking comfort in.
Let's U-turn and talk about some more currencies, the euro in particular. How far do you, there's been some speculation, euro-dollar parity. Do you see that in light of recent events?
Sure. I mean, regardless of what value you thought was appropriate for the euro before this weekend, you should have that lower after the results of this.
Is anybody going to go long euro at this point?
Right. I mean, well, there were probably people who thought that it had fallen too far. And so even if you were in that camp, the value that you should have in your mind has to be lower. The euro has signaled quite clearly they're willing to print money to get their way out of this, and that the ECB is no longer solely focused on price stability. They're looking at what's going on in the periphery.
And the pound, do you see more stability here now that we have, real quickly, a prime minister in place?
Well, I mean, the pound is going to suffer from the same forces that all of these countries are, and that there's just simply too much sovereign debt, and there isn't the resources to pay for it without printing.
Jacob Bourne is head of inflation trading at Capstone Investment Advisors. Many thanks.